we're talking about the percentage. What percentage? And you will say, oh, this is material amount. I mean, this, I can. You know, this is by any standard, this is the material amount. What would that be? That's the question. In other words, you go to audit after the program, and you find out this. Client gave you an initial financial statement, something fishy. And you find out source document and vouching, tracing, and find out difference is X percentage. How you decide? You can go to engagement partner anytime you have a question. You have to exercise your own judgment. The reason why you are getting paid a lot of money. See? And you are responsible for the financial statement also. The guideline they are using is this. Each accounting firm has a different guideline. The most conservative accounting firm, PricewaterhouseCoopers, see, they audit United States of America, U.S. government. Most conservative accounting firm. See, if any error amount is more than 0.5 to 2%, firm says this is a material dollar. Then who used 0.5%, who used 2%? 0.5% will be conservative firm, like PricewaterhouseCoopers, medium size, nationwide firm, national firm, regional firm, they might use 2% of the sales. So that range, company will be using guideline. And between this guideline or 5 to 10% of net income. Net income. Net income. If any error amount is more than this outside of this range, we say this is material error, material dollar amount. In this case, you know, sales did not happen. And they didn't satisfy two revenue recognition criteria, which is what? Which are two revenue recognition criteria.
Did you earn it? Is it earned?
Oh, did you earn it? And? Yeah, reasonable assurance. In other words, collection of money with reasonable assurance, risk has been shipped to the buyer, so you don't have any obligation or attached to this merchandise, attached to this service. You're done with that. So, just like Krispy Kreme, they just made this journal entry, and this is a accounting. They say fraud. Title says this is accounting fraud. The other one, this one here. By using company own cash to pay off customer invoice that were uncollectible. Now, what journal entry they are supposed to make? In this case, what is the correct journal entry they are supposed to make? Yeah, what? There's no cash available. But once you find out, oh, client is out of it, there's no way I can collect this money. Accounting. What journal did you use?
That.
Yeah, that.
And then AR.
Expense, and then
AR.
direct write-off. Oh, that's a finance guy. Rich Rockefeller. The finance people, Wall Street, they take out assets, but we don't do that. We use contra asset account, allowance for the outflow account. Instead of this journal entry, look at this journal entry. If you're under pressure to post target EPS, target earnings, this journal entry will ruin your trip. This must be observed by income statement. Instead of this, they are saying, oh, you know what? See, they have checking account cash. Oh, we got this cash from customer. So we collect account receivable. Now, by doing this, they are understating expense, overstating income, sustaining their stock prices. own cash fraud. This cash is not coming from customers. This is your own cash from your checking account. This is the bad news. If you go to work, you will face companies like this, clients like this. Not everyone. Going back to our prior discussion, you are a entry level what? Junior accountant, junior manager now, managing partner or engagement partner is putting pressure on you because what is the major company around here? I mean, the major pharmaceutical company here. Oh,
Johnson & Johnson?
Johnson & Johnson. I have account Johnson & Johnson. If I have a Johnson & Johnson account and I know Johnson & Johnson is doing one of these, would you insist adjusting journal entry at the risk of losing tens of millions of dollars account? Big question. Now, putting pressure. Engagement partner implying can say, you make this, sign up. They are implying, why don't you sign up? And you know from textbook, that's not correct. What is auditing standard of it? Generally accepted auditing standard, yes. There's a guideline in gas. Whenever you're under undue pressure from your engagement partner and management partner, you document your disagreement in the working paper. In the working paper, you document your disagreement with an engagement partner and then ask for reassignment. Most probably, you need to find another job sooner or later. Because number one, you will be under that pressure sometime sooner or later. And this engagement partner obviously lacked integrity in respect to. But remember, he's getting pressure from top there too, management partner. Because we are talking about Johnson & Johnson or Subaru, worldwide operation, Johnson & Johnson. At least for audit, $25 million. This is the problem. Well, I guess this article is just good article to use. Here, CPA firm, and this is client, your client. And here you have users of financial statement. It can be anyone. And here's the independent CPA in between. They rely on CPA audit with respect to Johnson & Johnson Subaru financial statement. Things are not that simple. Problem here is they have absolute expectation from CPA. Look, you're professional, you are getting paid a lot of money. If you audit this financial statement, I will have a blind trust on your work. I made $2 million investment, $5 million investment. But here, CPA and client financial statement, client and CPA, well, client will look for lowballing. What's the lowballing? They go around accounting firm. I'm not saying Johnson & Johnson and Subaru is doing that. No, I don't think so. But then let's assume one of the major corporations has some accounting problem. But I need clean, unqualified opinion. Yeah, well, I have to get clean opinion. Therefore, I will do opinion shopping. They are doing opinion shopping. I have this accounting problem. Can you still issue clean opinion? No, I can't because that is against generally accepted accounting principle. So a client is going around look for better opinion shopping, and CPA firm will say, look, if you give me my account, if you give your account $20 million account, guess what? I will do 5-year free corporate tax return. I will give you 20% discount on $20 million audit fee for the next 2 years. Look, if you give discount in order to recover cost, you will reduce sample size. If you reduce the sample size, you increase your audit risk, right? Audit risk is a function of how many risks? Come on, guys. Audit.
Inherent risk.
Yeah, inherent risk. Well, that we can avoid that. Inherent risk. Okay. What? Inherent risk. Look. See here. We are doing this. Audit risk is function of inherent risk.
Detection risk.
Huh?
The detection risk.
Yeah, detection risk. See, no matter how fancy or accounting model, econometric model you are using, there is a chance that this error will go through without detecting those errors. Detection errors. What else? Detection risk. What else?
Control.
Huh?
Control risk.
Control risk. Control risk. No matter how fancy internal control structure you have, there is always a risk that this error will get around your internal control for many reasons. Such as what? Reasons such as what? Sure, I have perfect internal control. Yet this error went through whole control system and printed in a financial statement. Which case? What example?
Human error, yeah.
Human errors. Collusion. See collusion? Collusion? So, question here is how to reduce expectation gap here. Here, they are expecting absolute perfect audit, absolute expectation. Here, they can provide reasonable what?
Assurance.
Yeah, that's what they can do here. Reasonable assurance as opposed to absolute expectation. Therefore, if something goes wrong, investors will sue who first?
CPA.
CPA. Why they settle suit out of court all the time? I mean, they know they're gonna win the case, but they pay cash, settle as soon as possible. Why? Why? I now know your name. Wait. Yes, sir. Yes.
Like Mike said, bad publicity.
Hmm?
Bad publicity.
Bad publicity. That reputation is their number one property. You don't want to damage your number one property. See, when they go to court, they have to show all their working paper. This is how we did. We follow gas and gap. They know they win the case. After they show all audit and working papers, everyone else will look at this paper, and you're losing your audit techniques to a rival company, and your reputation will be ruined. That's why, honest year, many years ago, $400 million cash right away. There was a class action suit. $400 million cash. That year, I heard, each partner drove the losses. Okay? 1 over partner share. See? We say that is a deep pocket theory. Because of deep pocket of accounting firm, they sue. Doesn't think about it. They sue independent CPA firms. They know they will get cash, and they know without fight they will settle outside the court. They don't want to tarnish their reputation, and they will come up with the cash as soon as possible to settle. This is the biggest point this profession has in terms of dealing with investment cases. They lose some money for some reason. They sue their independent CPA firms, knowing this. So, one is beyond accounting scope, which is paying only cash to, as if it is from your customer. So you are underpaying your expense and increasing your income. The other one is very familiar. This is not the first company who did it. There are many instances. International transaction, this happens all the time because look, if you say you have $20 million, $30 million merchandise in transit over the Pacific Ocean, however, as an international CPA, yeah, they have all the documentation, but how are you going to check?
By verification. By verification.
Yeah. Well, they have risk verification, and they rely on public document. Yet, revenue recognition is the other side of the transaction. If they have 5 major international sales to each continent, 2 million, 3 million from each continent will add up to 10 million right away. And if they say debit account receivable credit say 10 million, that will have significant material impact on the bottom line of the income statement. This is, ladies and gentlemen, what you are facing. I guess I broke bad news. But yes, can you imagine? You go to audit for this company and you and your team are examining their financial statements. What's the chance of finding out this transaction? Maybe probably no. Why? Unless you do extensive sampling, which will increase your audit cost, you're not making money. So they will say, okay, 500 sales invoice for the year. How many sales invoice here? 200,000. 200,000 file cabinet or an electronic a sales invoice, and you are doing random sampling of 500. What's the minimum sampling you need if client data has a perfect backup? They have a perfect backup. It's not perfect. Normal cup. Their data is from 0 to, let's say, 100,000, the biggest transaction, and here, this is the median, perfect, symmetrical distribution. How many random samples you need in order to say this population doesn't include any accounting error with 99% accuracy? That's the sampling, right? You don't examine all 200,000, 300,000 sales invoice. You're not going to make any money because they will charge a client to step accountants, okay, for this audit, 500 hours, the $50 per hour, junior manager, 300 hours, $100, senior manager, and we management partner, 50 hours, $500. Managing partner will stop by 5 hours, 1,000. You extend and come up with this is all the fee you will charge to the client. If you do 100% population check, you need about 2,000, 3,000 staff accountants hour, which is not cost effective. You lose money big time. So finding out distribution of your audit paper, audit exam document is the first. Depending upon how comfortable you are in terms of distribution of this, you will decide how many samples you need. Perfect, symmetrical, normal curve, 100%. There is no distribution like this. But if we assume there is a theoretical distribution of the curve, how many random samples you need in order to say 99% of the time, this data, total population 100,000, sales invoice does not include any error. Quantitative skill. First session. We are getting close. We are getting close. Quantitative skill we took. Yeah. Standard. Well, this is you don't have to worry about it because this is perfect. Larry Cantrell taught. Who taught the quantitative skill?
We didn't have that yet.
We're not even going to have that, are we?
The audit sampling in advanced audit, you did some
We did.
sampling.
Yeah, we did.
We did audit it.
Very include some sampling, right?
Well,
Theoretical sampling.
We are lucky because we hire Erica. Erica Harris left, and we hired someone from New York who had 10 years of Big Four accounting experience and worked for Lehman Brothers. I was hesitant when I reviewed his resume. He worked for Lehman Brothers. What did you do? I asked. And he said, I left 2 years prior to the collapse. He's okay. He's talking. He did the field work and everything. Tax accountants, master of accountancy. So next cohort will see. Yeah, see, if this is the 100,000 sales invoice, perfect symmetrical distribution, all you need is a random sample of 40 observations. Can you believe 40 observations, random sales invoice number 516, 910, 1015, 90,500. If you choose randomly 40 samples and find out there is no error, then you say, okay, 99% of the time, this 100,000 sales invoice does not contain any errors. Statistics. 40 random observation checking errors, few minutes. Yet you have 99% accuracy, predict, 99% accuracy. That's how you make money. This is only one sales the source document, sales invoice. There will be other invoices. Bill of lading, receiving report, all these different purchase order, purchase requisition, all these source documents. You have to do the tons of sampling. But if you know distribution of your sample, that's how you make money. Okay. So much for the introduction. We have session 2. We'll go. Let me see. if you happen to read interesting articles from a Wall Street Journal or any other website, just bring it to the class. We'll analyze it, make the debits and credits, and that way we'll find out what's going on in the marketplace, and that's the best way to learn. You just bring it and introduce the article, and then we'll do a whiteboard, and then make the left-hand side, right-hand side journal entry. That's the best way to learn a subject matter, I guess. See, module 1 and 2, you already know accounting, financial statement. The format, different title inside in each financial statement. That's not what we need to know. We already know. The problem here is US GAAP. US GAAP provide a prescribed non-matching accounting rule. This is none of your fault. US GAAP says use non-matching rule on your income statement. They know it's wrong, but there's no other option. And we'll talk about balance sheet, income statement, and cash flow statement equity from critical point of view. Critical point of view is this. We'll go to balance sheet here. We all know structure, left-hand side, right-hand side, what's going on. Now instead of liability and equity, we now right-hand side and left-hand side, order of liquidity, order of maturity, and this is the other way around for IFRS. This is for US GAAP, but then the other way around for IFRS. Now, assets, we know the definitions. Asset, future economic benefit arising from past and present economic transactions. It has to be, you must own, and then you have the item must bring economic benefit to the company. Specific definition of you must have control over this asset. If you go to Philadelphia Airport, there are aircrafts. They are leasing aircraft from Boeing. Operating lease. Sign 30-year operating lease, pay monthly rental expense. Asset? This is a Boeing aircraft, but you sign 30-year rental agreement, lease agreement, and you are going to pay monthly rental expense. My question, whose asset is this? Look at this. Who satisfies this? Delta? Oh, let's do, well, capital lease is even easier question. Let's do operating lease first. Operating lease. And who satisfies this? Airline or Boeing?
Yeah,
Airline, why?
because they're the one who have possession of the aircraft,
Mhm.
and they are deciding when the aircraft flies and when does it get service and so on and so forth. So they are in full control of the aircraft.
Okay. And their aircraft bring revenue to the airline. They bring economic benefit to the company. So in form, aircraft belong to Boeing. In substance, Delta will record this as their asset. Capitalist, for sure, a Delta airline, right? They sign, they have to recognize what? Depreciation expense, capitalist interest expense. Under operating lease, what expense you have? Rental expense, monthly. If you pay that monthly rental expense, you find that's all you have to pay. But under a capital lease, you need to pay depreciation of that aircraft. What else? Depreciation and interest expense. There's a huge capitalized mortgage obligation, capitalized lease obligation. So lease obligation is long-term debt. A long-term debt has an interest expense. Yes. So that is what we have to look at the substance. Who has? Your rule says even under the operating leases, now you have to capitalize and put everything under a balance sheet. Used to be off balance sheet financing. Operating lease was the example of off balance sheet financing. Why? You have a full access to asset, but then you don't show on your balance sheet. Off balance sheet financing. Oh, that was a manager's dream account. See, under capital lease, if you have an aircraft lease, you have long-term capitalized lease obligation. Lease obligation under capital lease. But under operating lease, this is the balance sheet. Operating lease, all you have to do is the income statement, rental expense. As long as you pay rental and monthly expense, I'm fine. But here, you have to show this. And income statement will have what? Depreciation expense and interest cost. Interest expense. Why? This is the major problem for managers. Long-term capital lease obligation. This is the reason why they want to avoid this. They want to do this. That's why they have 4 different criteria to avoid the capital lease. If you satisfy all 4 conditions, yes, you can use operating leases.
The capital lease scenario increases the debt to equity ratio.
Exactly. See, once you put millions of dollars here, your debt equity ratio will go up because your numerator will go up. Your numerator go up, and once your debt equity ratio is more than 2 to 1, forget about new finance. They will turn you back. Come back when your debt equity ratio goes below 2 to 1. 2 to 1. In most industry. So debt equity ratio, you increase your debt, so this went up. Accounting response to this problem, obviously, some of the accountants agree. Okay, if I have to increase this, I will increase my denominator, to bring this down. If I increase my denominator equity, how you increase your equity? With managerial options. You have these tools available. How? Yeah, I know you can issue stock, but if you have this much of a long-term capital lease obligation, worry about debt equity ratio, stock price is all the way down in the first place. You can't issue stock when your stock is all the way bottom. That is an out of option. How you increase your equity, numerator, denominator. What is the equity here? What is this equity? Common stock, the ATIC, and retained earnings. This one fixed. Stock you can issue. So only possible manipulation item is retained earnings. How you increase retained earnings? Income is income. Change accounting method. See, if you change it from LIFO to FIFO, FIFO income will be on a income statement. Income will go up. You change it from double declining balance method to straight line depreciation. From cost method to equity method of your intercorporate investment. There are millions of options to increase your net income, therefore increase your retained earnings. And if you look at how they manage their earnings for those who are on the borderline of a 2 to 1 debt equity ratio, it's amazing. It's amazing. when they make accounting changes, all accounting changes are in one direction, income increasing accounting method. Yep. We all know current, non-current is not within a year. What's the guideline between current, non-current?
Yeah, or a cycle.
For 1 year or operating cycle, whichever is
Sir.
Great.
longer, right? So California wine industry, their operating cycle current item could last 7 years. We have to find out that time period using financial statements. We just can say, oh, 1 year. Most of the retail 1 year, right? Because operating cycle is a few months. Say, for manufacturing, many cases, it's more than a year. In that case, it's not 1 year, it's an operating cycle because this is whichever is longer. See, this, I guess, we all know what current assets are. Now, I don't think we have any problem measuring it, now show in financial statement. That's not what we are here for. We are here to analyze these items, item by item, and what kind of decision we can make by looking at each of the items. Now, let's go to this balance sheet. We'll do balance sheet for you. Cash and cash equivalent. Three months late, 90 days, or 3 months or less liquidity is the cash equivalent. Good example of cash equivalent will be what? Good example of cash equivalent.
Security.
Yeah,
Federal security.
treasury bill, 30 days, 2 months, up to 90 days, or commercial paper. If you have invested in other commercial paper, anything less than 3 months of a maturity, then you can convert into cash within 3 months, then that will be cash and cash equivalent. Now this is a fair value measurement or current value, and there is no current market value because, well, you can say current market value, but not every asset has a market. That's why FASB is using fair value or current value. They are not using in formal accounting rule book. They are not using current market value or a fair market value. They stay away from this. But these are all almost the same. In this case, market decides supply and demand and price. This is more objective, but here sometimes you have to measure it. Fair value. Now, short-term investment. Short-term investment. This is short-term investment is measured at fair market value. Investment means securities and most likely a liquid asset and easily you can convert into cash a fair market value. Account receivable. What rule we are using for account receivable? When you measure account receivable, what is the measurement? Text.
The net realizable value.
Oh yeah, net realizable value, which is what? Gross account receivable minus allowance for the outflow account. We say this would be quasi fair value. You are trying to come up with fair value, but then this is not exactly fair value because look, gross account receivable minus allowance. Most probably we will collect that much of account receivable. So we say quasi fair value. For inventory, what measurement we are using? LCM. LCM. What is the market? We know cost, the money you pay to purchase this, inventory. Whichever is lower will be new cost on the balance sheet as an inventory. Then what is the market? Oh, okay, that will be for market. You have to do that is most likely close to replacement cost. What they have to pay in order to replace current inventory, that's the replacement cost. What else you need in order to determine market? Real techniques of measuring a LCM. You will have ceiling, you have floor, median value of this is median value. Ceiling selling price minus selling expense, and floor profit margin take away. So most likely, well, ceiling is higher than floor, but most likely replacement cost is in between. Median value of these three will be market, whichever is lower, market or a cost, historical cost, that will be new inventory amount. Since when we are using LCM? From reading your book, LCM. For some of you, you are not here when we start using it. This is a long time ago, 1972. 1972. See, we need to know the history of this. History is this. 1896. Price Waterhouse Cooper in London office sent two staff accountants to the colony, New York City. Go to New York City, see what kind of accounting market they have. Two CPA, chartered account, CA, that's then the British system, that's a CA, chartered account. And they say, they report to the head office, look, they are doing business very well and huge scale. There is a potential market here. And this is the first public accounting practice in the United States. 1896, two staff accountants from Price Waterhouse, not Cooper, Price Waterhouse, head office. Things went very well until what happened? They blame everything for that market crash. Yeah, there is an accounting profession share of blame. They blame fair value accounting because they are using 100% fair value accounting, and they blame fair market value accounting for a market crash because they say market price of a asset is fluctuating like this. Every quarter, every year, this price is up and down. Therefore, earnings are up and down. They don't provide any good information because it's not reliable. That's why market confused and they collapsed. And that was 1929. So 100% fair value right after SEC Act of 1933-34, after crash, they changed accounting to 100% historical. They made about face. See, 100% fair market value to 100% historical. Now, fair market value, fair value accounting is more relevant. We know that, right? This is more relevant. I mean, in order to make a good decision, you have to know market price. It's more relevant. The example of Manhattan Island, right? And here, 100%, well, we don't care now, after market crash, everybody is scared. So here, all we care is reliability. As long as financial statements are reliable, we're fine. We use this information. Then, they also set up a committee on accounting procedure. They issue the accounting rule. Back then, accounting rule is simple. Line 4, 5, 4, straight line, double decline, not even double decline, unit of output method, and some depreciation method. Committee on accounting procedure issued the accounting rule. And they survived until 1956. Committee on accounting. And then they say, oh, we need a more sophisticated accounting rulemaking body, accounting principal board, APB. And APB survived up to 1972 because they blamed APB for a responding to a market situation, too late. Accounting information is not available when we want to make a decision, so they replaced it. And then now we have FASB. Around this time, when they replaced APB, they made the first exception to 100% historical cost accounting, to inventory. Why do you think they have to make an exception for inventory? 1972. Well, overall, so many items. Why they pick on inventory? They made the first exception to here, inventory. LCM. Instead of historical cost, we'll go to LCM. Because US corporation will becoming multinational corporation. Inventory they are carrying, competition is going up, inventory they are carrying is time sensitive. If rival company come up with a better model, the inventory you have is scrapping. Scrap overnight. So inventory value is very fluctuating, and whenever they say they have this much of inventory, that will affect your income. Now we all know formula income. Inventory is ending inventory, and this is a cost of goods sold. If you have obsolete inventory, overstate ending inventory, you will understate cost of goods sold. Therefore, income will. If you carry huge obsolete inventory, that increases your income. That's why, look, for inventory, history cost doesn't make sense. Why don't you use LCM? That's why we have this account. This is the first exception to 100% history. Now, after 1972, all financial institutions and financial institutions or banks, they use fair value accounting. And today, they are pushing for market value accounting because financial statement must be relevant. So, 100% fair value, 100% interest cost, exception after exception, pendulum swung to now 100% fair value accounting again. We'll see how far this will go. One major obstruction to that direction is Mr. Stephen Choi, chairman of the Blackstone. His leading group, Wall Street, powerful, a CEO. You guys remember what happened here? This will bring fluctuation into financial reporting. Financial statement will not contain value relevant information. Therefore, reliability and usefulness of financial reporting will go down once we bring market fluctuation into income statement. We'll see. This is a question of making fine balance between yeah, I will get reading the break. I mean, I don't think we have we used to have it up here. They used to have yeah. inventory is one thing. The other is inventory is one thing, and product planting equipment. How you measure product planting equipment? Well, the net book value, right? And historical cost minus accumulated depreciation, net book value. And that's accumulated depreciation. In other words, wears and tears will be subtracted from original cost, and whatever you carry on the book will be net book value. So far, we have 1, 2, 3, 4, 5. All 5, to some extent, are subject to different valuation. So you say, okay, you say here, total current asset. What does that mean? If you add apples to orange, at the time of price fluctuation, you are adding different type of asset, and you are seeing this one line item current asset, and you are using that current asset to compute all different types of ratios. Current ratios, quick ratios, working capital. Now you name it. There are many different ratios you can compute with: inventory turnover ratio, account receivable turnover, and cash coverage ratio. We must be aware of the limitation of using each financial statement item. Now, long-term investment. How you account for long-term investment? You have long-term investment in other corporations. Long-term investment. Ownership differences, right? Ownership differences. Here, a alpha is less than 20%, then cost or fair value method. They now allow fair value method from 2007. Fair value method is combination of equity and cost, but then more close to cost method. You have a choice. If alpha is between 20 and 50%, what method you are using? Equity or a now fair value. Equity or fair value. What if your ownership is less than 50? As long as you own more than 50%, you consolidate into financial statement as if it is yours. You own 51% and you combine 100% of assets and liability. Fair? I mean, you own 51%. How come you say you combine, you own 100%, you combine 100% of assets and liability?
Because you control how those assets and liabilities are.
Say that again.
Because you have control over how those assets and liabilities
Oh,
are utilized.
See, according to entity theory, there are 3 different theories in combination. According to entity theory, if you control, you must include 100% of target corporation into your financial statement, because once you control, you will make a decision, such as production, financing, investing decision for the target corporation. You make 100% decision, you are 100% responsible, 100% combination of target corporation as long as you control. That's the entity. So test is whether you control. Look, Carl Icahn is controlling almost Time Warner. What percentage of ownership he has in Time Warner? 2%. How come he can control whole not 100%, but 2% ownership and control all this, influencing this? And he years ago he was threatening the CEO to pay dividend and buy back own shares at market price with 2% ownership? How can this happen? I mean, 2% ownership, you are doing major decision for a giant company like Taiwan. How? Because remaining 98% is owned by 10 million, 20 million small shareholders. You are the only one major block holder. Entity theory says, once you control, you have to. So, long-term investment, you have a long-term investment, but this long-term investment includes 3 different items, depending upon your intention of time horizon for this investment. What about a goodwill? How you measure goodwill? How much goodwill will carry year to year? Goodwill, you record original goodwill, historical cost, and if there is impairment, you will recognize impairment losses. Never overstate. Historical cost will remain the same, but when there is impairment, you have to subtract impairment. How you measure goodwill? Goodwill? Anyone know goodwill? This is a very popular item. If you go to Fortune 50 companies, they usually carry several billion to tens of billions of goodwill. Goodwill. How you measure goodwill?
Market value of the company which is for the buyer and for the cost which you spend.
Oh, okay. See, net fair. What you have to give the market price. Net fair value or NIA. We say net identifiable asset. How? In other words, fair value of asset, market value of asset minus market value of liability. That's the value of market value of the target corporation you are acquiring. Now, let's say this is 100 million. Now you are paying cash, bond, common stock, or a preferred stock, a combination of this of $120 million because it's an attractive target. Everybody wants to take over this because this will give them an easy access to the market. Diversification will be achieved. There will be synergy between main line of activity with this target corporation. They are willing to pay. There are many guys out there willing to pay $20 million extra. What is this $20 million? Goodwill. You have to pay premium. Now, this goodwill, according to intermediate text, which is the summary of your gap, what is the theoretical definition of goodwill? I mean, this is nothing but premium they pay, right? This is a premium. We simply say a goodwill, but what is what? Intangible asset. Intangible asset, which is coming from where? What is the definition of goodwill? Goodwill. Company. Johnson & Johnson. Subaru. Subaru, reliable car. Very. Now it's not cheap anymore. I was looking at Tribeca and Waka said Tribeca is discontinued. So I now goodwill is extra earning power of the company Johnson & Johnson, Subaru, because I have reputation in the market. I have a good relationship with the customers, loyal customer bases. Because of this, I have extra earning power. That is goodwill. But in practice, there is nothing like that. The premium you pay when you acquire target corporation is the goodwill. Therefore, this this item is there to make a balance between debit and credit, aka bumper car. Can you believe? You go to General Electric. I don't know how many what kind of goodwill. Let's say 10 billion. You go to General Office building, General Electric, G, and you say, let me see your $10 billion asset. You carry goodwill 10 billion. Let me see, and they will say, 10 billion asset is somewhere out there. You can touch, you can feel. You just take my word for it. We have $10 billion out there. That's this asset. Intangible, bumper car. Waste management. Waste management. This is now national garbage collection company, right? They grew 1980 and 1995. They go around the whole country and took over this smaller garbage collection company across the nation, and now this is a major a nationwide garbage collection company. When you go around and acquire regional garbage collection company, you have to pay premium, and they are even now they are having huge amount of goodwill because they did everything using cash, bonds, stock, people stock to acquire Target Corporation, because their idea was, let's have a big nationwide garbage collection company. In that process, whenever you pay, every time you purchase a Target Corporation, you are increasing goodwill. My teacher, Abraham Brilov. Anyone know Professor Abraham Brilov? I was assigned to research assistant for one semester, 1990 spring semester. If there is Nobel Prize in the accounting, he is the first one to receive. He passed away a couple years ago at the age of 96. Passed a CPA exam at the age of 17. Taught accounting at Baruch College more than 55 years. By the time I worked for him as a research assistant, he spent whole life reading, so he's a legally blind. He can't read. So my job as a research assistant, I go to office, pick up my work time is 9 to 3 Tuesday. So Tuesday morning, I pick up weekly a load of mails, and I go to his office, and I read every single mail he received. He has a column in Barron. Until fairly recently, before he passed the Barron. Have you ever heard this newspaper? Barron? Mm-hmm. Yeah, Wall Street Journal by the semi-monthly, twice a month. The Barron, the tabloid, not the full size tabloid. They had a column. He criticized waste management accounting. He said, I was surprised. I asked him to read the manuscript. He said, waste management is collecting goodwill like garbage. They sued many times. They sued him many times. They cut off scholarship fund to that college, 1980s, up to 1990s. Big 8, back then Big 8. Accounting firm never came to that school to recruit because of Abraham Brilov. Whenever he collect the company criticize their accounting practice, therefore Big Four accounting firm, 12% permanent decline in their market price, market capitalization. Can you believe? One article cuts off 10 to 12% of market value of that company, whoever he picks up. So if I show up, you will say like this: go to library, give me Exxon financial statement. Back then Exxon, not Exxon Mobil. Exxon financial statement. Magnify stockholders' equity. Because he is legally blind, he look at this way. He didn't use eyesight this way. If you say, Professor Willow, how are you? Then he will say, turn around and look at you and this side. Legally blind. And there's a huge tax benefit I find out by declaring legally blind. Tax reduction. So that's how I find out why Professor Willow voluntarily go to court and get this legally blind body. He had accounting with his daughter, CPA. Accounting office name, Briloff and Briloff. Not many clients come to that office for accounting work because Professor Briloff has the highest standard of accounting ethics in this country. So who's several major clients? Big names in Washington, D.C. and big names in Hollywood. They don't mind paying high amount of fees. And Professor Willow doesn't need many clients. That's how I learned. Waste management is a collecting good like garbage. And this one is nothing but premium they pay to bumper between this and this. Okay, this is goodwill, but other intangible assets. What about other intangible assets? Patent, copyright, trademark. How about other intangible assets? How you measure that on the balance sheet? What is the account? Right?
Historical cost, amortization.
Exactly. Yes. Historical cost is now amortization. How many years for copyright?
15,
17?
17.
But for tax purpose, 5 to 7 years usually for tax purpose, financial reporting purpose. What's the life of your copyright? Let's say you have a bestseller. You wrote bestseller. How many years do you have copyright? Life of the author plus 50 years, right? 50 years. Your grandchildren will be there. Up to your grandchildren. Great-grandchildren later. Other intangible assets, like copyright. What assets we are not recording here? Intangible assets. There are many intangible assets. There are some intangible assets we are missing from financial statement. What are those?
Like the management team expertise.
Oh yeah, first managerial asset. See, management expert is managerial asset. We don't record this. Stock price will nosedive if one of the high-flying CEO takes off and go to another school, a job, and that's a managerial asset. And employee in the top managers, group of employees, high quality employee, and this managerial asset we are not recording. What else we are missing?
The value of your own logo or
Brand asset, yes. We never record value of our logo, which is our brand asset. Coca-Cola, Intel, this is tens of billions of dollars. We don't show it. So what you see in financial statement is account receivable. Here, compared to this tip of the iceberg. What you're missing from financial statement balance sheet is much, much bigger than what you see on financial statement. What else we are missing? Managerial assets are not there. A brand assets are not there. What else?
Human capital?
Hmm?
Manpower.
Yeah, manpower. Employees?
Yeah. Manpower and high quality employee and all this, they are not there. I mean, some firm, they are doing very good because of the corporate culture. Corporate culture is that everybody is chipping in. They feel like there's a goal alignment between a top management and employee. They are moving in one direction. And you show that on stock pricing. Well managed with higher goal alignment, yes. What else we are missing? Sean, any comment on this? Sean is here. Matt, Sean is here. I already called you. Sorry. Matt. Sorry, it's okay. No hard feelings. What else is missing? I mean, here we list all this, and this is bothering me because think about high tech or entertainment.
Intellectual property?
See, all this. Oh,
I think you're using the permanent marker.
I was tweet, right?
There's water in that cabinet over there, I believe.
Water?
Yeah,
Okay.
water bottle.
Oh, okay. That one.
Are there water bottles there? Or they like must
They must took away. Let me. Fine. Okay. Here. Cool. Array of knowledge assets, intellectual property. See, knowledge assets. It's missing. Example of knowledge asset. If you see Microsoft financial statement, MSFT, years ago, they show land $120 million. Land. Yeah, $120 million, a lot of money. Don't get me wrong. Here, they don't show the value of Windows operating system. Windows operating system? How much? Well, that's their core property. They have Windows 10 now, right? 10? 9, 10? Yeah, they upgrade this, come up with better, higher version, and you have to buy it, you have to upgrade it. And they are making what value of Windows operating system? How much? You tell me. Tens of billions dollars is missing from here. Yet, land $120 million. So what? Does that tell you the real value of the company? No. What's missing here is really. What else? Let's think about this. What else? And they say this knowledge asset and technology asset, technology asset. See, now, 1960s, if company report net earnings, net income, stock price is explained by 70%. In other words, if you report net income, 70% of the information will be reflected in stock price. So, how stock price will go? About 70% of them by looking at the income statement. Right now, anywhere between 2 to 7%. 2 to 7%. In other words, net earning change explains stock price variation up to 2 to 7% instead of 70%. Why? Because there are so many big items are missing from a financial statement. We are looking at small tip of the iceberg and trying to make a good decision. And for the security investment, securities, if you have a bond and this intercorporate investment, also we all know trading portfolio and AFS and held to maturity, and they are subject to different evaluation. In other words, for this investment securities, what is the trading portfolio? What is the accounting for trading portfolio? For bond and stock, trading portfolio will be measured at fair value, gain or loss, unrealized gain or loss. This is a URG. Unrealized gain or loss. Look at the handout that Michael gave out. Great. This is a unrealized gain or losses. Unrealized. Now they didn't dump the stock or bond in the market yet. So the difference between market price and the money you pay, historical cost, will be gain or losses. Now trading portfolio, unrealized gain or loss, will go where? Where will it go? Trading portfolio, gain or losses. I pay $100 January, December 31st, 150. I still have a bond investment, but my investment value went up $50. So unrealized gain $50. Debit investment went up $50. Credit URG, unrealized gain $50. Where would you put this 50 unrealized gain from trading portfolio?
Accumulated OCI?
Hmm?
Does that go into accumulated OCI?
Oh, okay, yes. Yes. Unrealized gain or loss from here. Over here. This one? Yeah, this one is income statement right away. In effect, your EPS. Can you believe you still have in company safe deposit? You still have bond investment of Campbell Soup, Johnson & Johnson stock investment. Stock price up and down. December 31st, you look at how market price and then compute gain or losses, and it hits your income statement for the period. Therefore, affect your earnings per share. Because this is for immediate trading. Available for sale. What time frame we are talking about? What's the cut-off point? Trading is trading right away. Available for sale. What time frame we are talking? Year.
Wait.
I know this would happen. Yeah, the moment I hear 3 months, I was just trying to. Who said 3 months? 3 months? Yes. 3 months. Available for sale up to 3 months. And beyond that, while this is only bond, held to maturity. Held to maturity is historical cost bond plus minus amortization, right? For discount, you add amortization. For premium, you subtract premium and subtract amortization, and that 3 different evaluations. Okay. They say this is the total asset. There are many other items that we'll be talking about in the future. That's the total asset. Let's say $100 million. What? 10, 12 are subject to items. 10, 12 different valuation method. And we are looking at only one number here, which is the sum of apples and oranges. It is more challenging use. Let's say only one company. Let's say that is General Electric. Let's say that's a General Electric. I think it's safe to say because they include all the items. General Electric here. This is a general parent company, General Electric. Now, parent company General Electric financial statement, balance sheet here include all different items, 10, 12, 30 different valuation methods for balance sheet alone. Now, they have 1,400, about 1,400 subsidiaries. And here, subsidiary 1 through subsidiary about 1,400, you are adding General Electric financial statement, 1,400 different financial statements, and each of them use different valuation methods. And you add all this up to show consolidated financial statement. It's bad enough to have all these different valuations on one financial statement, but then you add 1,400 subsidiaries to show consolidated financial statement, and you are making credit decision and investment decision based upon this. Out of 1,400, 300 is retail, for example, so subsidiary. 100 is high-tech, retail, and 200 is financing, and others. Manufacturing, 300 is manufacturing, and yeah, let's say this. Out of 1,400 subsidiaries. This is the apple, orange, pear, grape. You are adding all this, and there is a big board. You slice them here. If you go to downstairs, in the top table, how you call this big board? Fruit salad, yes. Consolidated financial statement is a fruit salad. You know what? This fruit salad downstairs is tastes good. Don't get me wrong. Don't get me wrong. Fruit salad. When they make a fruit salad? When?
There's no real salad.
Yeah, that is true. That is true. When there is no real salad, they make this and fruit.
Before it goes bad.
Yeah, right before they go bad. No, they slice them up. They slice them up and they put everything before they go to bed. And what about the color of fruit salad? Colorful. Beautiful.
Looks good.
Yeah, looks good.
Makes you want to eat it.
Inside of fruit salad, banana is 5 days old. This grapefruit has been there for weeks. Out of 1,400 subsidiaries, some of them were about to file bankruptcy. And you find out a current ratio, and they say 2.5 to 1, and you say, oh, General Electric and 1,400 subsidiaries has a strong liquidity position, when about 400 are about to file bankruptcy. This is the problem. This is the law of average. See, in economics term, I'm not sure whether you fallacy of composition. In economics term, when you combine, everything looks good. When you dissect, that's if you dig in, yeah, you'll find out something. The reason why I kept emphasizing the limitations of financial statement is this. What you examining, what you spending your career with, financial statement, So for some of you, not all of you, some of you will be tax, cost of accounting, controllable, and some of you will be financial accounting. Even with the other area of accounting, you have to live with financial statement. Unless we know these limitations, there's a good chance that you will make a hasty decision. That's why people spend time, a lot of time reading financial statements. Reading financial statements. Footnote. Before we go to income statement, let me then, we'll go to liability, and that is the liability side here.
We can take a short break.
Okay, great. I was about to lose my voice. Let me erase this and we'll have a